This is where the experience we have in other markets it comes into play so much is that, if an investor asks me about risk management, deep down, I know they really mean price management, right? Like, how am I going to defend against a decline in the asset? But my answer is always, before you can even get into price risk management, you have to deal with counterparty risk management. And it's a boring answer, but it's probably the most important thing in crypto because of the fragmentation of the market, the number of different counterparties, the way you have to physically touch and hold the actual assets themselves. It matters a lot.
All right, welcome, Jeff. I appreciate you obviously joining us here today on the first, Zoom version of Derivatives Decoded by Kemet. Appreciate you joining us today. So, Jeff, maybe you can introduce yourself to everyone that's listening to us today.
Sure, and thanks for having me. Happy to be here. I'm Jeff Dorman, Chief Investment Officer at Arca, which is a full-service asset management firm dedicated to digital assets. We founded in 2018. We have multiple fund offerings giving different institutional investors and retail investors access to different aspects of the digital asset investing ecosystem.
Beautiful. So, Jeff, maybe walk me through your journey, right? Like, how did you get into this position? Like, what's your background? How do you end up finding yourself in the digital asset space?
Sure. Yeah, I'm an old guy for crypto. I started my career 25 years ago. I was an investment banker. I was a credit trader, trading investment grade down to high yield distressed credit assets on the sell side for about 10 years. Then I went to the buy side in the 2010s, worked for Citadel as well as some other long short equity and credit funds. I left Wall Street in 2014 and started working in at a fintech company just to take a break from investing, which I'd done for the first 15 years of my career. And lo and behold, every full stack developer that we were working with was mining for Bitcoin and Litecoin and Ethereum. So I think I bought my first Bitcoin in late 2016 or early 2017, purely from a macro lens. That was the part that made the most sense to me, having the investing background, but very quickly started understanding more of the technology lens because of these developers I was working with who were teaching me about open source code and the value and where it was headed. So ultimately, I moved to Los Angeles in 2017. I assumed at that time that there weren't a lot of people like myself who were, Wall Street, ex-Wall Street guys who were dabbling in crypto a little bit. And ultimately met my co-founder, Rain Steinberg, at Arca, who was similar to me, who had a wisdom, he was the co-founder of Wisdom Tree. He had an ETF background, and he was also dabbling in Bitcoin and Ethereum. And then, met all these people in LA that were also, dabbling in this. And pretty soon I saw a white space where there really just weren't a lot of people with true asset management experience and true fiduciary capital experience to run asset management firms in crypto, right? There was a lot of technology people who were running venture funds. There was a lot of, algorithmic or quantitative traders who were trying to figure out, just how to trade this from a volatility standpoint. There really wasn't anybody applying true kind of fundamental investing practices to this space, and we thought that was an area that we could take advantage of given our expertise. And what's interesting is 7 years later, there's still a white space there, right? If anything, the chasm has gotten bigger. There's way more venture firms and there's way more algorithmic trading firms and still very few fundamental investors in this space. And that's, the niche that we tackle here at Arca.
Beautiful. So, maybe, tell us a little bit more of the approach that Arca takes from a fundamental investment perspective. How you guys differentiate yourselves from the other asset managers, all that, there are a few, right? But how are you guys different?
Sure. Well, first and foremost, we still exist. I think the majority of the industry went out of business. I guess that's a differentiator. No, the big one is, again, most of the people who come from that's from a technology background or a venture background, right? They're looking at things like just growth metrics, total addressable market, looking at how big something can be, Metcalfe's law, things like that, right? And again, if you look at sort of the traders that are out there, they largely don't even care about the underlying assets. They're just looking at the correlations, the volatility, the relationships, et cetera. It doesn't really matter if they were trading, crypto or equities or, currencies. It's all, plug it into a model and see what it spits out. But what we think is that the majority of these tokens really can be categorized, right? I mean, it's almost to the point where this isn't even really an asset class. It's just a wrapper that can hold all types of asset classes. meaning like there's nothing similar about Bitcoin to a smart contract platform to an application that's more equity like, right? We have currency like tokens, we have commodity like tokens, we have equity like tokens, you have debt like tokens, and all of these can be analyzed using similar valuation techniques to what we've always used in the debt and equity markets. And that's really the approach that we take, which is we've learned a lot over decades of doing this in other asset classes, right? I mean, in my career, I've invested in every asset class, I've invested in every region, I've invested in every sector. I wasn't an auto mechanic, but I understood how to invest in autos, right? I'm not a doctor. I understood how to invest in healthcare companies. You can learn all kinds of different sectors and areas of finance just by understanding finance. You don't necessarily have to be a developer or a technology driven minded person to understand how to value these assets. So that's what we spend all of our time doing, is looking at these assets and quite frankly ignoring most of them, right? We ignore the ones that we can't value. We ignore the ones that are jokes or memes or just funny, and we focus on the ones that we can come up with some methodology for why there's actual value.
So I'm guessing you guys did not get involved in Trump's like coin at all, given what you just said.
Well, I'll caveat in the sense that there's nothing off limits, in the sense that our funds are designed to give investors exposure and access to any parts of the growth of blockchain. But no, we were not involved in Trump because again, it's fine. Again, there can be plenty of different types of use cases of the same technology, but from an investing standpoint and a valuation standpoint, what are we going to do with Trump? There's no valuation. It's fun for retail. It's fun for people who are just trading for the sake of trading. But there's no investment analysis that you can do on something like the Trump coin.
No, of course that makes a lot of sense. So, given you guys are like fundamentalists, right? Like it doesn't make it's purely driven by hype. I guess this actually drives another personal curiosity of mine. Of sort of like, how are you managing counterparty risk? You've been around for a while. Well, it's great that you guys have survived a lot of that issue, right? Like where the majority of other sort of similar firms that were trying to offer similar sort of services like pretty much have failed due to the lack of risk management adequately. Like maybe tell me more like the morphing of this process internally within Arca. Like how do you guys learn from the past? How do you guys manage risk? How do you assess counterparties? And that in conjunction with the fact that liquidity is fragmented anyways, so you still have to face a bunch of those, right, in order to actually execute on whatever you're trying to execute on. So maybe walk me through some of that.
Sure. And this is where the experience we have in other markets comes into play so much, is that, if an investor asks me about risk management, deep down, I know they really mean price management, right? Like, how am I going to defend against a decline in the asset? But my answer is always, before you can even get into price risk management, you have to deal with counterparty risk management. And it's a boring answer, but it's probably the most important thing in crypto because of what you just said. The fragmentation of the market, the number of different counterparties, the way you have to physically touch and hold the actual assets themselves, it matters a lot. So we spend more time on counterparty and due diligence risk management than we probably do on investment risk management. And again, this is driven largely from, I was a credit trader in 2007 and 2008. I remember when it didn't really matter what you owned, it mattered who you owned it with, right? You might have the best position in the world in CDS, but if your counterparty was Bear, Stearns, or Lehman, or MF Global, it didn't matter what your position was because your counterparty was failing. 2022 was a great example of that, right? I mean, a lot of the types of price hedging that we might normally do, using options or using, lending, didn't exist in 2022 because our counterparties were failing, right? It wasn't the assets themselves that were failing. It was the service providers around the assets that were failing. So we spend a lot of time on the due diligence front, working with our counterparties and doing the same type of due diligence we would have done in TradFi, which is, if you can't produce an income sheet and a balance sheet, we're not going to work with you. If you can't, satisfy the questions on our due diligence questionnaire about how you safeguard the assets and timing, can we get a person on the phone, et cetera, we're not going to do business with you. And it served us really well in 2022, avoiding a lot of the landmines. But I think deeper than that, it's also just, reemphasizes just how important this is. Back in my TradFi days, you'd have a prime broker. You hear the term two guys in a Bloomberg, right? That's how easy it was to spin up a hedge fund. You just get a Bloomberg terminal, you get a prime broker, and you go. Maybe once a year, a new service provider would pitch you on something, and it was largely just semantics, right? I mean, you were never going to switch service providers. It didn't matter if you used State Street or BNY, or if you used Barclays or B of A. It was like, these were standard 100-year-old institutions that everybody used, and it was like a formality to check what service provider you had. That's not the case in crypto. Even the best firms and the biggest firms in crypto are basically less than 10 years old, right? There's no 100-year, legacy institution in this space that is a tried and true counterparty that you can just check a box. So it takes a lot of work to understand the risks and who you're dealing with, how they interact with you, and if there's a red flag, you pull your assets pretty quickly. And that's that's the nature of this business until you get real regulation and have a true, prime broker in this space.
This honestly would drive another separate discussion altogether that I would love to get into, but like pulling those assets, moving liquidity, execution, right? The ability to actually execute very efficiently in this market, with the help of technology. But I'd love to maybe leave that aside for a moment, because you didn't mention, right? Like in TradFi, it's pretty standard, right? There's a prime broker that kind of offsets a lot of that risk, right? That has been well tested, been around for years, right? Decades, hundreds of years, right? In the digital asset space, do you see any of, some of the existing firms that are out there that are presenting themselves as prime brokers anywhere near that level of maturity? I mean, today at Arca, are you guys relying on a prime broker in some of your, bilateral sort of relationships or tri-party relationships?
I mean, look, the reality, the joke I always had was, the prime brokers in crypto, all they did was basically put the word prime broker on their website. They weren't actually offering prime broker services, right? I mean, the point of a prime broker in the traditional markets is effectively trade first, settle later, right? You essentially can do whatever you need to do and not worry about where your assets are or how you ultimately settle, because you have T+1, T+2, T+3 settlement. By definition, that's not going to work in crypto. There never really will be a true prime broker, in the sense that you have to actually have the assets before you trade, right? You mentioned the fragmentation. Fragmentation is nothing new. I mean, I was a bond trader. We had 60 counterparties when we were trading bonds. Now we probably did 90% of our business with 5 of them, but the other 55 were there in case you had some obscure one-off trade to do. But again, we didn't have to hold assets with them to do the trade. You do the trade first, and then you have T+1, T+2, T+3 settle that your prime broker would take care of. That's just not the case in crypto, right? You have to physically send the assets there first in order to trade. And that's just not going to change, right? The whole point of this technology is T+0 settlement. So the only way that changes is if you eventually have a counterparty that is bigger than all of their clients. And that doesn't exist right now, right? I mean, even the biggest and best in this industry don't have the balance sheets that are as big as their clients. And until that changes, it's just not going to work, right? I mean, the only way a prime broker would work in this space is if they have, hundreds of billions of assets across all the different counterparties, and they own everything, and ultimately you can just do a trade and settle it through them later. And again, it's not the case. Even the ones calling themselves prime brokers in this market effectively make you deposit the assets first before they trade it. So that's that defeats the point of what we're doing here.
That's very true. I mean, but like another aspect of, I guess, the so-called prime brokers in the space like do provide is like this whole DMA situation, right? Like the ability to kind of give you access to the liquidity venues, regardless of like individual counterparties, right? When you think about like trying to trade on Binance, on Derivatives, on OKX, on any of the offshore exchanges, where like if you do have the legal setup to do so, you still would prefer to kind of do that through a managed account from another party, right? Or am I mistaken? Is that not the model that most would prefer to kind of go through?
I don't think it's the model that funds prefer. I think it's the model that funds have been forced to utilize because of regulatory restrictions in being able to access these places directly. I mean, again, like in a perfect world, you wouldn't want a fund to be directly trading on every single exchange because, again, it's very capital inefficient. You have to move assets here and move assets there, right? It's in general, this is a pretty capital inefficient industry because of that fragmentation where you have to move your assets first in order to source liquidity. So what you're describing in a perfect world is great, but I don't think it's because Again, I don't think it's because they have access and funds don't. Eventually, that's going to go away, right? That's a regulatory issue, not a functionality issue. Nobody wants to be restricted from where the liquidity is. So that's not the offering that is valuable. The offering that is valuable is, again, the ability to trade first, settle second, where you don't have to spend that time moving assets around. And that's what a true prime broker could offer in this space if, again, they have a big enough balance sheet to be able to do that.
But I mean, even if the regulatory sort of side of things fixes itself and you don't necessarily require that function from the prime broker, right? Wouldn't that be still considered a stepping stone towards true capital efficiency, aka like you need actual cross margining before, across all these different venues? Because I think that's, I've had conversations with a lot of fund managers, and a big issue is sort of it's not just about getting access to margins. Like I want to be able to effectively use one account across all these different venues and actually not have to think about sort of how my margin is sort of dealt with on each one of these different venues individually. Do you think that we're going to be in a world where that is
happening? I think we'll get there eventually, but again, I think that becomes more interesting when, I mean, look, this is a little off topic, but I think I'll be able to bring it home at the end here. So, in some ways we've gone backwards in the last year and a half, right? We have this great technology blockchain that offers T+0 settlement, and can be traded globally for free instantaneously, right? So what did we do? We took this great technology and instead we went backwards and jammed it into an antiquated ETF box just to give the rest of the world access who doesn't know how to trade on chain, right? So one step forward in the sense that you're getting new investors into this ecosystem via an ETF, but two steps backward in the sense that it's going to slow down actual adoption of blockchain and on-chain services. So think about like DeFi, for example, right? If you look at any chart, shout out to the block. If you look at the dollar volume of trades going through on decentralized exchanges versus centralized venues, it continues to go up. It was like 1% 5 years ago. It was like 7% 3 years ago. And now it's like 15 to 20% of all trades are going through decentralized venues. That's great, except for the fact that most of the assets that are traded in decentralized venues are assets that 99% of the world doesn't care about. Like take, go back to October of last year when you had that huge vol shock and that VAR shock when you had the yen carry trade unwind. And brokerages and banks around the world were like going down and couldn't handle it, right? That's the biggest advertisement for DeFi ever. And that if you wanted to trade your Apple or your Tesla stock, but you couldn't because your brokerage account was down, it'd be a great time to transfer those assets to Aave and get a loan, or transfer them to Uniswap or Aerodrome or Radium and trade them. Huge advertisement for DeFi, but at the end of the day, it didn't happen because for regulatory reasons, we can't trade stocks and bonds and other assets on chain yet, right?
Yeah.
So ultimately, we're in a sort of a binary situation right now, which is like the technology works, DeFi works, on-chain works, the assets available on-chain all for the most part kind of suck relative to the assets that most people care about, right? People care about their Nvidia stock and their Apple stock and their Tesla stock and their Amazon stock and their treasury bonds and their you name it, right? Their home equity. So ultimately, to your question, trying to bring it back home here on the prime brokerage standpoint, is like, that's when this gets interesting, right? Is to your point about cross margining, like, yeah, I would love to be able to hold my equities and use those as margin to trade crypto or vice versa. Until we get that, it's just not a very useful service yet. Again, it's really only useful to the funds who physically can't do it themselves and don't have access to these different venues. I think that's where we're headed. Is ultimately, again, you need some of these bigger banks and ultimately regulation to allow it, where these companies who have basically unlimited balance sheets can offer these services for you. As much as I love the quote unquote pseudo prime brokers in the crypto space, the balance sheets just aren't big enough. They can't do what a true prime brokerage would offer you. And as a result, ultimately they just become a pass-through that charges you a fee for what you could do yourself.
What do you see in terms of timeline then, I guess, for us to get to that maturity level, right? Both in terms of the actual counterparties that have the balance sheets, right, to start showing up and actually, being involved in the space. And two, the holy grail of like actually, the framework allows for the tokenization of anything, right? Like your Apple stock shows up on chain. Do you think this is going to happen like too far in the future? Or are people excited that it's imminent?
I call this the crypto investor paradox right now, which is, to give you an analogy. Imagine if airplanes existed
Mhm.
But the government only allowed you to transport, I don't know, something stupid like rocking chairs. Like the only thing you could put on a plane was a rocking chair for whatever reason. There'd be a lot of investors who are like, wow, I can see where airplanes are headed. This is a great technology. I'm going to invest in the airplane because it's going to be huge one day. But if you actually looked at usage of airplanes, it would be pretty low because at the end of the day, not that many people care about transporting rocking chairs, right? And you can expand this analogy to, imagine if email, the only thing you could do was like forward jokes. And that would, like, again, people would want to invest in this. Be like, okay, I can see where email is going. There's a lot of cool things we can do with email. But at the end of the day, there wouldn't be that much usage of it because most people don't really care about forwarding jokes. That's basically what blockchain is at this point, right? We know it works. There's tons of investors in this space who understand where we're headed, but there's just not that many users of it because nobody really cares about,
What's on it? Yeah.
what's on it, right? So we have to head there. I mean, that's why I said it's pretty binary. You have to get to a point where people actually want to use it and not just talk about the future use cases. So to start with, you just had the repeal of SAB 121, right? That's a huge win for banks being able to custody. I think but Brian Moynihan, CEO of Bank of America, just said in Davos last week, like, yeah, of course we'll get involved. Once the rules allow us, we will. Like, so the first is getting the banks and the brokerages to actually have, from a regulatory standpoint, the ability to custody and house and trade these assets. Once you get that, then once the banks and the brokerages and the investment bankers see that it's profitable, well, then they start pitching ideas, right? Like,
Let's pick a chain and package something and put it on there.
exactly. Like for instance, airlines is to stick with that because it's in my head right now. Like airlines is the most over levered business in history. Like every 7 years they go bankrupt, right? They literally will just they have all their planes are debt financed. Like 4 or 5 years ago, one of the investment banks pitched a debt deal that was backed by airline miles, right? I mean, it's just like over levered, right?
Yeah.
Nobody in the investment banking world is pitching, hey, United, how about we issue a token? And that token can be, a quasi-equity, quasi-utility token, meaning maybe 10% of top line United revenues will be dividended back to token holders, but also token holders can, get discounts when they purchase tickets, like, or, basically like it's a combination of,
like free upgrades or like something.
a combination,
Yeah.
a combination of United equity and United miles combined into a token.
Mhm.
Now, why does that matter? Well, it matters because current United mileage holders and frequent travelers on United really don't they don't care about United's success, right? They don't care about if they're not a shareholder of United also, they could care less about United as a company. There's no alignment. They don't care at all if United succeeds or fails. Ultimately, if United goes bankrupt, it doesn't matter. They'll restructure and your miles will still be there. And conversely, you could be the biggest shareholder of United and never fly, right? There's no alignment between shareholders and customers and something like that. You issue a token where all of a sudden, okay, I'm getting 10 or 20% of top line revenue dividend down to me, plus I'm getting all these perks. Well, guess what? I immediately become the most, the biggest evangelist for United ever. Not only am I going to fly more, but I'm going to tell other people to fly, right? Why do you think Binance became the biggest company in the world faster than anyone? It's because of the Binance token, the BNB token. They gave 20% of profits back to token holders, but you could also use the BNB token to get discounts trading on Binance and to use it as collateral for options and futures. That alignment of token holders as quasi shareholders and evangelist, diehard customers is why Binance grew so fast. So why are investment banks not pitching this? Well, because they can't make any money off of it right now, right?
Yeah.
Once the banks start custodying this stuff and trading it, well, then the investment bankers start pitching it. Like there's no shortage of creative investment bankers. As you said, they'll package anything into anything. They just know they can't profit off of this right now because the banks can't touch it. So once that happens, then you're going to start seeing a Netflix token, a Disney token, a New York City token, a Harvard University token. It's not just going to be these meme coins. You're going to see real uses. And once that happens, then again, you get into the cross margining. You can trade, back and forth seamlessly from your United Airlines token to United stock to Netflix stock, et cetera. So I think step one is getting the banks and brokerages and investment banks involved. Step two is then the fungibility, where literally everything is tokenized and ultimately, nobody will ever even own cash ever again. Like, what's the point of owning cash if you can send all of your assets as payments? So, you're going to look at your phone one day and say, my net worth is $100,000, and that's $20,000 worth of home equity and $30,000 worth of Bitcoin and $20,000 worth of Tesla stock and $30,000 worth of, jewelry or car, tokenized assets. And, then you make a $10,000 payment and just pro rata takes it from all of your liquid assets. So like that's where we are headed. But again, we're so far from there that it's just speculative at this point in terms of like when it happens and how it happens.
I think I agree with you. Like it's definitely a question of like when, not if. But that's a world that like can be extremely exciting for a lot of people, right? Not just the financial sort of aspect, like from a trading perspective, but like this effectively would, make everything super liquid for everyone, right? The ability to kind of just move things around instantaneously would make a lot of people's like lives easier, right? This is one-on-one just elevating like the globe, honestly, like from a wealth perspective altogether. Because now anyone can tap into their actual net worth and not have to consistently, right, like just think about their whole world as illiquid besides the cash or some of the stock they own in Robinhood in that sense.
Yeah, Aave is a great example of it, right? I mean, like imagine if every person on Robinhood or on Schwab or E-Trade or whatever could just take all the stocks they already own, and once in a while, if you need cash, just lend it on Aave and take the cash. I mean, it's like again, it's not that Aave doesn't work. It's not that Uniswap and Aerodrome and Radium doesn't work. It's just that 99% doesn't. Yeah. 99% of the world just doesn't care about the assets that it works with right now.
Very true. Beautiful. I guess another question that I might have just conclude with here a little bit is just talking more about the pains that you go through day to day at this current stage as an asset manager in that space, right? Like there's obviously a trading life cycle involves so many different things. We talked about counterparty risk and how Arca sort of approaches that, but then, post onboarding, what are some of the biggest pains that you guys have been through and have already been able to solve? And what are some of the pains that are still yet sort of a big issue on a day-to-day basis that you want to be able to resolve, right? Whether that's like execution, risk management, portfolio management, like what are some of those that, kind of feels that have been solved in a previous life of yours outside of crypto, but yet still to be solved here?
Yeah, and I mean, first of all, shout out to the Arca operations and trading team who just do a tremendous job of this stuff. I mean, when we first started Arca, I mean, it was everything we were doing was a spreadsheet and hacking stuff together, and now there actually are a lot of great systems and tools out there. I mean, we have great portfolio management systems. We have multi-sig wallets and some counterparties that do a really good job of helping us move assets and trade assets. It actually is functionally way easier and smoother. I mean, it used to take us, I'm going to say it used to take us half a day, even just to like mark our books at month end when we first started this fund. Now in like 15 minutes, we can have it all done and, reported. So there really are amazing tools out there, software tools that has made this way safer, way easier, and way smarter in terms of how we run a fund. Where there has been less progress has been on the education front. For those familiar with Arca, I mean, I've been writing a weekly blog for 7 years. We've been doing monthly investor calls. We've done tons of, educational webinars and white papers and resources. And then it gets drowned out by some guy on Twitter talking about a meme coin who has 600,000 followers, right? And it's like, I think the biggest thing that we run into constantly is just the lack of education. Most people just lump everything that is traded on blockchain rails as the same thing, right? They're comparing a Trump coin to Bitcoin to, a BNB, even though they are totally different, right? Bitcoin is a currency. Trump is literally just a social, meme, and BNB is a, $100 billion company with, massive cash flows. So the analogy I always say is like, imagine if I just told someone like, I'm an ETF investor. They wouldn't just brush that off. Like, well, what the hell does that mean? Like, what type of ETFs are you trading? Are you trading equity ETFs or fixed income ETFs? Like, what's your strategy, right? It wouldn't just be, but if you tell someone I'm a crypto trader, like, okay, like they just assume that means you trade everything. If I go on a, CNBC and I tell them, yeah, we are a fundamental based manager of equity-like crypto tokens, within 5 seconds, they're going to ask me for a Bitcoin price. How many long short equity managers have gone on CNBC and been asked about gold? Like, it doesn't happen because there's education, right? When Bed Bath & Beyond and GameStop and AMC, stocks were going nuts, and you had this, Roaring Kitty and all these meme stocks. If you were if you were BlackRock and you were doing a conference, people wouldn't spend 90% of the time asking you about those 3 stocks because they can compartmentalize. They can say, yes, the stock market largely is this great tool for building for capital formation for companies and for investors to earn a piece of those profits. And yeah, there's this weird other area of equities, but we're going to ignore it because it's just a tiny piece of it. Whereas in crypto, you go to some conference, you're wearing a suit, there's hundreds of people. People are going to ask you about Dogecoin. Like it's just there's no compartmentalization. They're just assuming all of these things are the same just because they're built on the same technology, and it's just not the case. So we have to spend so much time on the education front of like, yeah, there is a huge difference between a DEX that is a profitable business, and you can, go on Token Terminal and see their revenues, and you can go on Dune Analytics and see, on-chain activity, and you can actually model this using free cash flow analysis versus, a fart coin, which is a joke that people just trade because it's fun. And then that's literally what we're up against all the time. And one of the ways we try to explain this to people is 150 years ago, go read Reminiscence of a Stock Operator, right? I mean, people used to trade stocks without even understanding what market cap was. It was only in like the 1920s when Graham and Dodd came out with the, investor playbook, and then Buffett decided to use that, where people started to normalize ideas like price to earnings and price to cash flow and, other metrics that are now adopted. But again, that was just a construct that somebody came up with, and over hundreds of years, people figured out that that's how you do it. So if you give 10 equity analysts the exact same inputs, they're probably going to give you the exact same output now because they're all using the same methodology. 50 years ago, that wasn't the case. 100 years ago, that wasn't the case, right? That doesn't mean that stocks didn't have fundamental value 100 years ago. It just meant that there wasn't a uniform, approved way to value them. Right, that's where crypto is right now. There are ways to value these assets, right? That you basically every single crypto token has some combination of financial value, utility value, or social value, right? Financial value meaning straight up cash flows that you can analyze. Utility value meaning it's useful in some way. Either you can stake it, or you can, pay gas with it, or you can lend it or something, right? And then social value, obviously, just being fun factor, right? Memes and other things. A lot of tokens have all three. It's cool to, Solana is a good example of that right now, right? Solana has financial value. It definitely generates real revenues from MUV. It has utility value and the fact you pay gas with it and you can use it to buy other assets in the Solana ecosystem. And there's obviously a cool factor, it's taken off to be part of the Solana ecosystem.
Yeah, it's like the fun, like the founding stone for a lot of these new meme tokens altogether, right? So a lot of people like to look at Solana as basically just the fuel behind any meme at this point.
I mean, there are value these assets, and it's just not an accepted, the Graham and Dodd equity book from the 1920s, or the Frank Fabozzi fixed income Bible from the 1960s. Like, that book just hasn't been written yet. Like, there's just not agreed upon valuation techniques. That doesn't mean there's no value. It just means people don't understand what that value is, which is great for alpha. It's great for active management. It's very hard from an education standpoint when the range of understanding of what this asset class is so wide. I mean, we talk to some investors who are literally on chain every day, trading meme coins and using lend borrow protocols and understand this stuff, inside and out. And we talk to some who literally don't know the difference between, like I said, a BNB and a Bitcoin and a fart coin. So it takes time to get the masses to understand where the value propositions really are in the space, and quite frankly, to be able to compartmentalize and ignore some of the nonsense that is fine to exist, and I don't care if people use it, but it's not the asset class.
Arca, as an asset manager, are you seeing your flows starting to skew a little bit more towards the regulated venues compared to the existing world of crypto native liquidity? So I guess one clear example would be IBIT and IBIT options. Are you seeing, is Arca, seeing itself also being part of in that movement of starting to execute more of your speculative or, trying to represent a certain view on the market more using IBIT options compared to options up there, for example? Or is that yet to happen on the RA?
We've always had access and continuity to all different venues of trading, from traditional TradFi regulated entities to more the crypto native, I don't want to say unregulated, but not different regulation. To us, it's always just come down to price, liquidity, counterparty risk, et cetera. So things like the ETFs have introduced a new way to get access to, essentially here's how you operate as an investor, right? You come up with an idea. You come up with a theme or an investment thesis. And then ultimately you go bottoms up and say, what's the best way to express that theme? So for instance, if you were bullish on Bitcoin, one way to express that theme would be to own spot Bitcoin and custody it yourself. Another way might be to own MicroStrategy stock. Another way might be to own Bitcoin mining stocks. Another way might be to buy call options on IBIT or to buy, options on Derivatives. There's all kinds of different ways to express the same view. So ultimately, the most important thing for us is what is the actual investment thesis. And then when we analyze the different ways to express that view, it might toggle back and forth based on price, based on liquidity, based on counterparty risk, et cetera. So we have not been that involved in the ETFs or in IBIT options, largely just because they're pretty efficiently priced relative to what we can get in other venues. But we're always looking at it if that changes. And the other day we were buying a call spread on Bitcoin, and we definitely did analyze the difference between buying it on buying an IBIT call spread versus buying via Deribit. And it was just cheaper and better on Deribit for a lot of reasons, right? One was, again, going back to the prime brokerage and the collateral issue, like it's hard to go across to a brokerage account because you have to leave a different set of money over there than we're already using over here. So, if we own some Bitcoin, we can send that Bitcoin to Deribit and use that as collateral to buy some Bitcoin calls. But I have to sell that Bitcoin into cash and send that cash to a brokerage account to then do the exact same thing using IBIT options. So most of it comes down to capital efficiency. If you're a crypto native fund like us, generally the crypto native counterparties are more efficient. If you are if you're Millennium or Citadel and you're not crypto native and you have to do it all through other entities, it's probably going to be more capital efficient to use the CME or to use,
Yeah, that makes a lot of sense.
And that's where this fragmentation is sort of a problem. It's like that, there's no reason for it to be fragmented. We need to get to a point where you can seamlessly trade your stocks and your crypto and your bonds all in one entity and use them for margin and collateral at the same time.
Beautiful. Jeff, I really, I'm glad that we got a chance to actually chat. This has been extremely educational. I guess I wanted to wrap this call with one last final question just to get your thoughts on this as someone who's been in that investment space for quite some time. Like, what are your views on this administration's kind of approach to a strategic reserve on crypto? Like, how do you essentially digest that kind of statement by Trump and this administration?
So, I'll caveat by saying again, I own a lot of Bitcoin personally. We don't do a ton with Bitcoin in our funds because it's not a fundamental asset. But in my opinion, not investment advice, that Bitcoin is less risky today than it has ever been. It is less risky at 100,000 than it was at 5,000 because of the fact that it has reached this critical point, a critical mass, where it is being viewed as a very liquid, safer asset, as collateral, as potential store of value, as potential gold replacement. There's just more eyeballs and more money and more options of people buying this than ever before, right? Again, I said the ETF was one step forward, two steps back. I mean, the one step forward was, again, it's democratizing access to Bitcoin from people who otherwise maybe wouldn't have touched this, right? So I think the strategic reserve is just one component of that, right? I mean, we've already seen, look at the progression, right? First, you went from just crypto native kind of tech junkies buying Bitcoin. Then eventually it was macro guys, and you had the Paul Tudor Jones announcement back in 2020. And then it went to corporations. You had Tesla and MicroStrategy, and now we're talking government. So, that's the natural evolution of an investor base, to go from basically, cyberpunk to hedge funds to corporations to RIAs to ultimately governments. It doesn't stop, right? That kind of movement just doesn't just stop. So I think it's actually shocking to me that more investors aren't front running that strategic reserve at this point, because it's one of the most obvious end kind of games that we've ever seen. And like I said, it's just way less risky today than it's ever been.
I 100% agree. Jeff, I really want to thank you for the time that you spent with us here today. I appreciate, obviously, all your views and getting to learn more about you and Arca. Thank you for being a guest.
Absolutely. Appreciate you having me.